I'm gonna go back. I'm gonna go deeper into DocuSign. Actually, do you see any ones you want to go over? Or just go to DocuSign.
Yeah, no, DocuSign's a good one to look at. I mean, it's
All right,
been a
let's take a look at
big
that.
stay-at-home
Been a stay-at-home play.
I know we
Yeah.
have Jen, our favorite realtor from Boise, Idaho. I know these realtors are using DocuSign,
Yeah.
to close virtually, basically. So there's a lot going on with the product.
Yeah. No, it's really good. You could do it all through like your mobile device. You just like click your signature really quickly, and it's all saved. It's emailed to everybody. It's a nice tool. Let's take a look at how the stock reacted after reporting earnings versus what the straddle was implying. So these bars up here, this is what the straddle was implying to move up or down, right? So here we start at 0. You could see the straddle. That's how much it had to move up or down to cover the cost of the straddle. So, for example, the one I'm hovering over right now, December 3rd, after the market closed, DocuSign reported earnings. That day, stock was up 5.3%. The straddle day before was implying a move of 8.4%. So that move was more muted than the straddle. Here, you could see on September 5th, 2019, DocuSign reported earnings. They were up 21.7%. Day before, the straddle was implying a move of 11.5%. So that move busted right through the straddle. If you sold it, you had to buy back higher. It was a loser from the sell side, winner from the buy side. If you see a red bar, that's just indicating that the move was to the downside. So June 6th, 2019, DocuSign reported earnings. That day it was down 12%. Straddle was implying a move of 10.9%. So you could see that it moved, it went below where moved more than the implied straddle by a little bit. So if you sold it, you had to buy back higher. Let's take a look at the stats. So in the last 12 quarters, the straddle overestimated the move 82% of the time. On average, the straddle was implying a move of 11.8% versus historical realized move of 8.4%. So you could see here that most of the time, right, the move was more muted than what the straddle was implying. That's what this is saying. So a couple times it busted through right here. This one by a lot, this one by a little, but it was within. And these brackets, these bars here kind of tell you, and you could see here that they've been all over the place, right? It doesn't look consistent. Sometimes they're wider, sometimes they're narrower. So there's not a lot of consistency from quarter to quarter, because I see a really wide one here, wide ones out here, smaller ones over here. So just keep that in mind. It's not very consistent here. It looks to me like on the lower end. Let's take a look at the implied volatility really quickly, what that did, and then I'm going to look at the numbers. So here we're looking at a 30-day constant maturity option to see what the implied volatility did from the day before to the day after reporting earnings. We're looking at a volatility crush, and we're looking at a 30-day option because that has more vega than near term. They have more gamma, so you're playing the move more with the near term. As you go out further, there's more implied volatility, so you're playing the implied vol crush as you go out further. So 30-day constant maturity, we see that on average, day after reporting earnings, the implied volatility was down 30%. Day before earnings, the implied volatility on average 74.5. Day after reporting earnings, implied volatility fell to 52.2 on average. 5 days later, 50.7. So continue to decline a little bit. Let's take a look at how, I'm just looking at these numbers up top, and it just does, the more I look at fundamentals, the more I'm like, whoa, these things are priced high. But let's just take a look really quickly from a fair value perspective.
Well, it's interesting because Jake is the one who's asking for the fundamentals the most, and he's been communicating these fundamentals just don't look right for a long time.
They don't look, yeah. And we've seen the thing with stocks is that they'll probably stay undervalued for a much shorter period of time than overvalued, right? Because undervalued, you're going to find people who are just going to go out, like start buying companies. If you're getting good returns, you'll take them private or you'll start buying them. When they're overvalued, there's not much you could do, right? You could short them, but they could continue to go.
Yeah, and we just
overvalued.
We just witnessed how painful it is to be short, right?
Yeah, so there's not
money
much.
managers lost billions of dollars.
Yeah, they could stay like that for a very long time, and sometimes it proves right. Sometimes those earnings catch up. Eventually catch up, but sometimes they don't. Eventually they get crushed. But you don't have a lot of cushion here. When you're investing in these, you got to be really right. So just here, I'm just comparing this to how where the historical price to sales was in the last 3 years in DocuSign, right? So if we go, it doesn't have any earnings really, it's all over the place, so it skips this. But just looking at the average price to sales ratio, 19, which would be considered, I think, pretty high. Here, I'm going to click on this just to show you how, this is how it just zoomed up, right? So price to sales is your market cap divided by the sales, your total revenue, right? So this is market cap expanding much faster than the total revenue. And you could see how far it expanded. And look, I like DocuSign, nothing about the company. I'm just looking at it from the perspective of, valuation. If we compare historically, how did that measure up versus the rest of the market? So we see here that today, the DocuSign price to sales 30 versus the SPY 2.9. So it's like a 900% premium. 3-year average, it's at a 672% premium. So if it goes to that, these are the implied values. This is the average. So you could see here, multiples expanded by a lot. I'm going to take a look at, here, let's go to the earnings estimates.
Talking about the DocuSign and the sales, you got to wonder how much ability they have to raise their prices. Once it becomes embedded in a client's, process, right, for dealing with clients like Jen, who's one of our longest active chameleons, who's also a realtor. Yeah. She's saying it's, time is money, right? And it has it has shortened her time where she used to have to sit and point out to clients and mark, it does all that for you, right? So the client is just click here, click here, click here. If you haven't clicked all the right boxes, the computer tells you got to go back to this box and click it.
It's a good product. That's, what do they say? If you don't have to invent a new product, but if you could create something that saves you time, people will pay for it, right? Because time is money. So if it saves you time or makes things easier, simplify, people will pay for it. And DocuSign figured that out. And I think it's a great product. I'm just looking at it. Okay, your market cap, is 30 times the revenue, right? So revenue it's not a PE already. This is just, you have to make some kind of margin out of this. So it's 30 times its sales. I'll just take a look. Here's the last report, December 3rd. The stock was up 5.3% after reporting earnings. It beat by 9 cents on earnings per share, beat on revenue, 21 million. You could see it for the quarter made $382 million. And it's been going up. Look, from 155, it seems like consistently it's been growing, which is a good sign, right? It's just how much do you assign it? Let's just go to the press release real quick. I'm just gonna take a look at it if I could figure out their margins. So here, look, total revenue grows, they're giving you the highlights, 53% year over year. That's a phenomenal growth rate, right? Here's its subscriptions, 366 million. Gross GAP, gross margin, 74%. That's a lot. Gross margins, 74%. That's a lot. You probably, that's on the high end. You're talking about probably like biotech and software. That's where they're at. Non-GAAP income 22. So look, they do have some good, good numbers. Is it worth the 30 price to sales? Here's some, new products. So maybe people are excited about these new products. I'd have to read more about them, but they do have stuff in the pipelines that could boost their revenue. They're giving you outlook here. So these are all important to take a note of. They're giving you here, look at the outlook that they're giving you, 404 subscription revenue. So that's higher than, right? So you could see here, they're expecting 407 right now is the estimate. So from fourth quarter to fourth quarter, 265, 404. That's a substantial growth rate. Again, you got to catch up to that. Price to sales 30, S&P 2.9. Let me just see what it did post earnings drift, and then I'm going to move on. But here's how are investors, traders feeling coming into the earnings, right? So after reporting earnings, you could have a good earnings, you could have bad earnings. As we saw, the press release gets issued, people put those numbers into their models, they reprice it that day. What happens the next 3 months? That's expectations being built up into the next quarters. What are the numbers? What do we think the management is going to guide us to and say? So here we see historically between earnings, on average, the historical drift was 19.8%. So on average, they went up 19.8% between earnings. These are the graphs here. I'm going to come down here. Okay, on its average in the last 12 quarters, it moved up 19.8%. 60% of the time it drifted higher, 40% it drifted lower. So you could see some big moves. It makes some big moves here. Standard deviation is 36.4%. So what did it do this time around? It was down 12.6% since last reported earnings. Here we are, down 12.6%. So even here, with good guidance, with the market going up, it's having trouble, pushing prices higher, and I think it's this valuation already. I don't think it's anything wrong with the company, just the valuation might have gotten ahead of itself. So we only have 5 minutes left. Will, do you have any questions on this?
We did have a question. Let me go back. There's so much chat going on. It was from Robert Black. He says, is there a way to scan all stocks to see the difference between the valuation and the SPY that Dimitri was just pointing out? This was maybe back a little bit. It seems
so he's talking about to scan this. So no, not right now. But
hey,
you've
gone underwater. Your noise, your sound isn't working. I don't know if you want to check out.
Should I log out or can you
log out and come back in? All right. Everyone, I'm assuming, heard Dimitri's sound is bad. We have, thanks to Mike Moreau, he just sent up a microphone. We got a new microphone on order. Hopefully that will help that out, even though I've been told it may be a Zoom issue. For those who don't know, Jake is a published writer on Seeking Alpha. I did post a link in there to one of his newer articles. Always worth a read and a follow for Jake44. Check him out on Seeking Alpha and in the Discord. For those of you who are active and you want to get into the Discord, I can send you an invite. Email me at williammcbride.com. Hey, D, good to see you. You're back.
Yep. So the question was, is there a way to scan for this?
Yep.
This is a relatively new feature, and I'm still enhancing it. So I think you don't see it even on this version, but we're adding, besides PE, price to sale, I'm going to add price to book and price to operating income. So before we even get to the screeners and stuff, I'm still enhancing it. The other thing what we're doing is, so this is looking at how the valuation compares to historical levels. against itself. I'm also adding forward looking. What do we, if we do assign it a growth rate and an operating margin, this is what we're going to be looking at for the next 5 years. And we compare that to the overall market. How's that price, right? So we're going to have two models, one looking at observable data, historical data, one looking at a projected growth, right? We can't accurately project it, but we're going to use the data that we have available to try to see how does that measure up to the rest of the market, to see, is it, if we give it growth, is the growth overpriced or underpriced? So that's the thing we're working on now. So you're going to see two models coming up for this implied value.